In this video, I'm going to answer the question, how much cash to close will I need with a hard money lender? I'll explain how a hard money or private money lender calculates the amount of money you will need to close. And if you stay tuned till the end, I'll also share the number one reason most flippers fail. I'm Alexis HART McDowell with Epic Impact Investors, a full service and self funded hard money lender. We currently have projects going on in Chicago, Illinois, and Atlanta, Georgia. So if you're in need of a hard money loan, fill out our quick and easy online application at epicimpactinvestors.com. As you may know, hard money or private money loans are a form of financing typically used in real estate investments. It's known for its quick approval times and the fact that it's asset based lending criteria, which means hard money lenders focus primarily on the value of the property being purchased. This makes hard money loans a go to resource to finance fix and flip properties or other short term real estate investments. Hard money lenders require you to bring cash to closing for several key reasons, all of which align with the nature of the lender's investment strategy. Remember that it's about the lender's investment strategy and the increased risk that they undertake by focusing primarily on the assets after repair value. So, the number one reason that most hard money lenders will require you to bring cash to closing is that they need you to have skin in the game. That's right. They require borrowers to contribute their own funds to ensure that they have a significant personal financial stake in the success of the project. They want you to feel something when you go work on this project. I need to complete this project because I need to get my money out of this project as well. They want that level of commitment from you because that level of commitment from you, the borrower, reduces the risk for me, the lender, by decreasing the likelihood that you will walk away. That's the number one reason. They want you to have skin in the game. The second reason is you need to cover your upfront costs and fees. Hard money loans come with higher interest rates and additional fees. I'm going to go through an entire list of fees that I actually pulled off of a recent closing statement. And these fees are not wrapped up in the loan. So you have to bring cash to closing and to cover these upfront costs, ensuring that the loan amount is dedicated to the property's purchase price and the renovation costs. Those two things we want the bulk of the loan to go to. So here is the list of closing costs that I took off of a recent closing statement. First and foremost, you'll have loan charges, right? That includes origination fees, broker fees if you use one, a commitment fee, a valuation fee. Sometimes the lender is going to escrow 3 months of your initial payments so that it gives you a little runway before your first interest only payment is due. You'll also have prepaid interest. That's the interest from the date of closing to the first day of the next month. You'll also have loan doc prep, title review fees, title charges. You'll have state transfer taxes, county transfer taxes, and possibly municipal transfer taxes, depending upon where the property is located. You'll have recording fees for the mortgage and the deed. You'll have your attorney fee. And of course, they're going to require builder's risk insurance. And that premium is either going to be on the HUD or you're going to have to pay that in advance. But either way, it's coming out of your pocket as the borrower. The third reason is that the lender is trying to mitigate their risk. That is why the majority of lenders, depending upon what state the property is located in, will only lend up to 65% of ARV. That's the after repair value. Your payment of the other 35% helps create instant equity in the house, which provides a buffer to protect the lender in case you default and we have to quickly foreclose and resell that property. There's enough equity in there for us to pay for the foreclosure and get our capital back plus some interest and still get that property offloaded at a decent market value rate or under market value rate at that point if it's not finished, right? So that's the reason why they will cap it at 65 to 75% of ARV. And again, it depends on the state that you're located in. So requiring all this cash at closing helps to align the interests of you, the borrower, and me, the lender, ensuring that both parties are committed to the project's success while managing the inherent risks of this investment. So you're taking some risk and I'm taking some risk. When we have those in alignment, that's when both of us are going to work together to make sure that this deal is done. Now, As promised, since you stayed to the end, I'm going to share with you the number one reason most flippers fail. As you can imagine, it's because of lack of capital. That's right. They don't properly anticipate all of the possible cost overages and they end up running out of money. First and foremost, your rehab costs are always going to go over. Material, labor, things start to skyrocket from the time you start your process, your rehab, to the time that you end the rehab. So you've got to make sure that you have some contingency and extra capital to pay for those increased costs. You're going to have additional loan fees as well after the loan is taken out. That's right. A hard money loan is typically for a 12-month term, which means you'll have to ask for an extension after that point in time. And most hard money lenders will happily give it to you. They'll give you a 2 or maybe even a 3-month extension, but you're going to pay 1% of the total loan amount every 3 months that you need. So if you took out a $230,000 loan, you're going to pay $2,300 for every 3 months that you need. And every lender is different. But the point is, you need to make sure that you calculate for that in your budget. You also have to remember you need to have money for your interest only payments. Remember, if you don't pay that, you're at risk for default, and then your interest rate is going to double. And now your interest only payment is just through the roof. So you want to make sure you have enough money to cover your interest only payment every month. Also, you have to have enough capital to float the project from beginning to end. Hard money lenders work off of a reimbursement schedule, which means we don't front you the funds. You have to spend the money. The work has to be done. You have to show proof that it's been done. We'll send an inspector out and then we'll reimburse you for that. So it's a reimbursement basis. And remember, as I stated in the construction draws video, we don't even reimburse that last draw until the project is completely done. So you'll need additional funds to make sure that you can finish this project out completely. And the last thing people don't account for is for city inspections, fines, and fees. Depending upon what type of municipality you're in, a city, a village, a township, they may have their own types of inspections. They may drive by, there may be garbage out front. Some workers left something. You're going to have to pay a fine for that. They'll have fees for the various permits. If you have to have something done over or an inspector has to come back out, that can add up quickly. So those are just some of the areas that people overlook when they're putting their budget together and then they end up running out of capital. So to avoid that number one reason, while most flippers fail, you are definitely going to need to have more capital on hand than you would think. Now, if you're interested in getting a hard money loan for your next fix or flip project, visit us online at epicimpactinvestors.com. Fill out our quick and easy loan application and then download the free resources we have for you there. They'll help you have a successful project. And if you found this information helpful, then go ahead and subscribe to our YouTube channel and turn on your notifications. Until next time, take care.